Wall Street intentionally uses confusing language to keep you poor and make investing sound like an exclusive club. They throw around words like beta, volatility, dividend yields, and capital gains just to make you feel overwhelmed, so you leave your money rotting in a savings account while inflation eats it alive. But the stock market is actually the greatest wealth-building machine in human history. And once you strip away the fake complexity, the concepts are ridiculously simple. Today, we are translating all that finance bro jargon into plain English so you can actually start building your own portfolio. Let us start with the absolute basics. You are basically choosing between being an owner or a lender. When you buy a stock, also known as an equity, you are buying a tiny, literal slice of ownership in a real company. If that company grows, your slice becomes more valuable. You are an owner. On the flip side, when you buy a bond or fixed income, you are just lending your money to a company or the government. They promise to pay you back with a set amount of interest. You are a lender. Bonds are generally safer than stocks, but they offer much lower returns. To build serious wealth, you need to be an owner. Trying to pick which individual company will win is mostly a gamble. Instead of trying to find the needle in the haystack, just buy the entire haystack. That is an index fund. It is a basket of hundreds of stocks you buy all at once. The most famous is the S&P 500, a list of the 500 largest companies in the United States. Buying a single share of an S&P 500 index fund makes you a part owner of Apple, Microsoft, Amazon, and 497 other massive companies. It is instant diversification. You might also hear about an ETF, or exchange-traded fund. An ETF is basically the exact same thing, but it trades on the stock market like a regular stock, so you can buy and sell it all day. Next, let us talk about market movements. You will constantly hear about bull and bear markets. A bull market is when prices are rising or expected to rise, officially a 20% increase from recent lows. Bull markets are full of optimism. The economy is booming, and these periods last a long time. A bear market is the exact opposite. Prices fall 20% from recent highs. People panic and think the world is ending. The biggest mistake beginners make is selling everything during a bear market out of fear. In reality, a bear market is the best time to buy stocks because everything is on sale. When the market jumps around, people talk about volatility, which is simply how wildly a stock price swings. Wall Street measures this with a term called beta. A beta of 1.0 means the stock moves exactly with the overall market. A beta of 1.5 means it is 50% more volatile, like a risky tech startup. A beta of 0.5 means it is 50% less volatile, like a boring utility company. How do you actually make money? There are three main ways. The first is dividends. Some companies make so much profit they just take a chunk of cash and pay it directly to shareholders. The dividend yield is that annual cash payout expressed as a percentage of the stock price. If a company pays $3 a year and the stock costs $75, your yield is 4%. You get a 4% return in cash just for holding the stock. But watch out for the yield trap. If a stock crashes from $100 to $20, the yield mathematically looks massive. That usually means the company is dying and the dividend will be canceled. Stick to safe 2 to 4% yields from stable companies. The second way is stock buybacks. Instead of handing you cash, A company uses its profits to buy its own shares off the open market and destroy them. Think of a pizza cut into 8 slices. If you own one slice and someone destroys 2 other slices, your remaining slice now represents a larger percentage of the entire pizza. Buybacks make your shares more valuable without triggering the taxes you would owe on cash dividends. The third way is capital gains, the profit you make when you sell an investment for more than you paid. Buy at 50, sell at 150. You have a $100 capital gain. Timing matters here. Holding the stock for less than a year is a short-term capital gain, taxed at your normal, high-income tax rate. Holding it for over a year is a long-term capital gain, taxed at a much lower special rate. This is why day trading is highly tax inefficient. When you are ready to use your brokerage app, you need to know a few terms. The bid is the highest price a buyer will pay, and the ask is the lowest price a seller will accept. The gap between them is the spread. A market order tells the app to buy or sell immediately at the current best price. A limit order means you only want to buy if the stock drops to a specific price. A stop-loss order is an automatic trigger to sell if your stock drops to a certain price to limit losses. Then there is short selling, which beginners should never touch. Short selling is betting a stock will go down. You borrow shares, sell them, hope the price drops, buy them back cheaper, and return them. If you buy a normal stock, the most you can lose is your initial investment. But if you short a stock and it skyrockets, your potential losses are literally infinite. Knowing these terms is useless without a strategy. Successful investors use boring, systematic strategies like dollar-cost averaging. Instead of guessing the market bottom, you invest a fixed dollar amount on a regular schedule. If you invest $400 every month, your money buys fewer shares when the market is high and automatically buys more shares on sale when the market crashes. It removes human emotion from investing. You also need asset allocation and diversification. True diversification means owning different sectors like healthcare, energy, and tech, and different sizes of companies. How you allocate your assets determines over 90% of your returns. Also, watch out for fees. A traditional mutual fund might charge a 1% fee, while a low-cost index fund charges 0.08%. Over 30 years, that 1% fee can eat up over $120,000 of your wealth, paying for a fund manager's yacht instead of your retirement. The secret to the stock market is that it is not an exclusive club for geniuses in suits. It is a tool for anyone willing to learn the vocabulary and apply basic discipline. Stop letting rich people gatekeep wealth with confusing jargon. You do not need to be a finance expert to win this game. You just need to buy broad index funds, invest consistently every single month regardless of what the news says. Keep your fees low and let compound interest do the heavy lifting over the next few decades. Start small, stay consistent, and let time build your fortune. Thanks for watching. We look forward to bringing you more financial information and tools to help you live a better lifestyle. Visit payoffdebtpro.com for more, and don't forget to like and subscribe.